Hello, I hope all of you are well and safe as always. Let's take a quick look at divisional performance appraisal. In fact, we started looking at it in the live sessions last week. I specifically talked about responsibility accounting, and I showed to you how, depending on a particular division's responsibility lines, depending on which component, which line they are in charge of, how we assign the responsibility to them, and under which you would have noticed we looked at, or we kind of separated responsibility centers into cost centers, revenue centers, profit centers and investment centers. These were the four types, out of which I told you that in this chapter we will be heavily focusing on what an investment center is. Let's take a quick look. A center that is responsible for the making an investment, this is a center which will be responsible for capital investment as well as financing. Its performance will be measured on return on capital employed. So how do you, if you are, in particular, if you are a divisional manager, right, of an investment center, how do you manage that division? How do you measure the performance and identify whether the division is doing well or not? This is the Ubhato Kotika Prashna we have at this point. So in this case, an investment center has both costs and revenues, and manager, if you are the manager, you do have the authority to invest in new assets or dispose of existing ones. So technically we are looking at an entire division, so to speak. No, even if you take a company like Haley's, we are talking about a subsidiary of Haley's, because a subsidiary of Haley's group will be an investment center. They have costs, they have revenue, and they have the authority to invest, right? Capital expenditure. So both OPEX and CAPEX are relevant to SBU. So that a SBU can be termed as a investment center, guys. There is absolutely no question there, no problem there even. So on that note, how do we measure them? As far as P5 is concerned, we use three metrics. One is the return on investment, the other is the residual income, and the third one is economic value added. And we go on to calculating these, and just knowing, not purely calculating, we don't get very highly technical. So I'll keep it quite simple, right? Because the ratios itself are things that you've looked at. You've already learned these three. You know what ROI, RI and EVA are. But for us, as far as P5 is concerned, for us what's relevant is how do we use this? How do we utilize them and decide whether an investment center is doing well or not? And depending on our decision, depending on our observation, how do we make further decisions whether to scale the division, whether to close the division down, whether to reinvest further within the division. So these kind of decisions are what, as P5 students, you get to make. So you have to have a very good ability to critically evaluate these three ratios. So as far as the ratios are concerned, ROI is simply profit over capital employed. So you know what ROCE is, return on capital employed. The only difference is here it's just a name change. Same ratio, different name. ROI, we use the word I because in this case we will particularly look at the investment of the particular division. So if you have three divisions, you won't use the same divisional capital employed figure for the three divisions, or you won't use the blanket entire company's entire company's investment figure for all the divisions. What you'll do is you'll separate that entire total capital employed into divisional figures and use them. That's the idea behind calling the equivalent of ROCE when looking at divisions ROI, return on investment. So if you look at your study text, at ROI, they use the word controllable. That's basically to insinuate the idea that I just proposed to you. We need to look at divisions, no? So we need to look at the division's controllable operating profit over division's controllable capital employed as a percentage. If ROI is greater than the required return, then we will accept it. If the ROI is lesser, we will reject it. So you would have heard this word, when you look at investments, a lot of people, everyone just wants to kind of look at the ROI. Any investor, you go and talk to any investor, they'll ask you, what's the ROI? Right? Because they want to know. They want to know what the ROI is. And so you can go through, these are the generic advantages and disadvantages you've continuously seen. But ROI will definitely cause some issues, which we will look at it in the live session. One is dysfunctional decision making and the other is holding on to old assets. We'll see how it happens practically in the live sessions. Now, because of certain challenges that you have, and also obviously ROI is an accountant's ratio, which means it can be manipulated, it can be subject to various, manipulation would seem negative, but it can be subject to creative accounting. You can creatively fool around with the numbers and make certain changes, show what you want to show, etc. In such a situation, we have to go with, or rather we need to look at alternatives. One of the alternatives we use is residual income, which is not a percentage, mind you, it's not a percentage. It doesn't work in a percentage manner, which means comparing residual income of one division to another division is a little bit of a tough figure, because you can't do it. You can't just absolute figures, you can't just compare the absolute dollar figures that you get as RI, because RI is a dollar answer. And you get your controllable operating profit, which was the same here. In this case, when it came to ROI, it was the numerator. This, you take the controllable operating profit from which you deduct your interest or imputed interest, notional interest. There are different words to this, but what you do is you assume money is not free, no. So because money isn't free, we have to assume that the capital employed we've invested on a particular division or on a particular department has a cost, and that cost is what we call imputed interest. Now, if it's a bank loan, if it's a direct bank loan or debt, you will get the finance cost here, right? Your capital employed, which is your principal amount of the bank loan, into interest rate, cost of capital. But if it's not a bank loan, there are other ways to fund a division. There is equity, for example. Now, in such a case, how do you go about this? Which is why they use the word imputed or notional. So from whatever your operating profit is, you deduct your interest or the cost of financing the project or division, whatever is remaining, the balance, the money that is left with you even after settling the finance cost is what we call the residual income. Very rightly, very appropriately named, no? Residual, what is left? The residual income, and what is finally left after settling everything, including the finance cost. That is what we mean by RI. Of course, it's a pre-tax figure. The decision rule is that if RI is positive, it means things are good. You can accept it. But if the RI is negative, we have a issue, because you haven't even made enough money to cover your finance cost. This is making you lose money every time, every month, every year. If RI is negative, it means you're just the cost of financing is too much for you to bear. Right? The project is not financially viable for you because you're spending more on investing in the project rather than what you're making from the project. That's why RI is the decision point of RI is whether it's a positive or negative answer. That's how you go about it. So even with RI, there are certain issues and challenges, and you can notice that one of the most basic issues is that you cannot compare, right? It does not facilitate comparisons between divisions because RI is a dollar figure, and depending on the size of the division, depending on the characteristics of the division, these figures will change. So we will roughly take a look at these on the live session as well. I just want to go about it. I'm doing this, redoing it because, as you know, I'm redoing some of the content. Annuity depreciation is something we will come back later. Now, already this idea that you have learned, do you remember by some chance? I hope you do, with possibly Hashan, right? You do with Hashan. You would have remembered in your F2 or F5 paper, when you do NPV calculations, sometimes you get to compare projects with different lifetimes. One project is 3 years long, the other project is 5 years long. Now you have to compare and decide which project is better. In such a situation, it's tough. It's difficult because the durations are different of the two projects, one 3 year, one 5 year, and if the durations are different, the risk element is different. And if the risks are different, you can directly compare the NPVs and say this project has a higher NPV, so we need to go ahead with it. You can't do it. So in such a situation, what did you do? You calculate an annualized NPV. Okay, you annualize the net present value. That is the same thing you do here with depreciation. You annualize the depreciation and you call it annuity depreciation. So an example is here. We will take a look at it when we go about the live session. And finally, RI has an issue. Now if I just put down the RI formula for you, the residual income formula, RI is residual income is equal to what? Controllable operating profit minus cost of capital into controllable capital employed. Now there are issues here. One, what is the cost of capital? How do we determine whether this is the right cost of capital or the wrong cost of capital? These are problems. So, right, what if the project is a mix of both debt and equity? Then what do we do? There's an issue there. Now, when you look at controllable capital employed, what exactly are we considering the right number as controllable capital employed? Is controllability correctly determined? That's a question you have to ask all the time. And when you say capital employed, do we go about just calculating the liabilities and the equity and say this is the capital employed the way the accountants do, or does capital employed have a better way to be calculated? Is there a better definition to capital employed? These questions come up because there are challengeable, questionable things about capital employed that you get to ask as a management accountant. A financial accountant, of course, there are IFRSs and you do along that, but how many IFRSs have changed over time? Every year they keep changing IFRSs because they realize that IFRSs are designed in a very in a way that benefits whoever is designing them at the time it is being designed. That's what happens with IFRSs. That's why you see frequent changes, right? Just like tax codes, right? Why do you see so many changes to tax codes? So this is a questionable issue. If this is questionable, then obviously operating profit is going to be an issue. What exactly is our operating profit? Now you have this whole prudence concept, right? You have the cash basis and the accruals basis. If you have sold on credit and if you have considered it as revenue, then your operating profit will be larger compared to a situation where you ignore the credit sales as viable sales. Those buggers might pay, might not pay. Now, something that you frequently see in the COVID-19 period. Now, in such a situation, can we just agree with the accountant's operating profit? That is also an issue. Therefore, what do? We come up with, we adjust this. We adjust the capital employed, controllable operating profit figure. We adjust the cost of capital. We adjust the controllable capital employed, and the final result we arrive at is, we call this adjusted capital employed. Sorry, adjusted operating profit. And also tax, tax, isn't tax something that we need to pay? Here, if you are considering the finance cost, Isn't true residual income what you get after you pay the tax? Those are little questions that you can ask to question the accuracy of this formula. So that is why we need to, so somebody asked them and they came up with the answer that this is not perfect, because of which we need to adjust it. How do we adjust? We call it adjusted operating profit, popularly known as NOPAT, net operating profit after tax. Very simple idea. Then cost of capital, we convert it to the weighted average cost of capital, obviously, right? You know this. And controllable capital employed, we call this adjusted controllable capital employed. And this formula, the one post adjustment, is what we call EVA, economic value added, which is a registered trademark of Stern Stewart and Company. They are the ones who founded it. Adjusted operating profit minus WACC into adjusted controllable capital employed. It is the same equation that you wrote for residual income. Same equation. Only thing is you do adjustments. Why do we do these adjustments? That is a question you need to ask. I will give you two main reasons. So why do we adjust? Why do we adjust? Two main reasons. Reason number one, always go with the cash basis, not the accruals basis. Not accruals, cash. So any non-cash flow elements that you see in these numbers will be removed, will be adjusted for. That's one of the main adjustments that you make to these numbers to arrive at EVA. Reason number two. What is that reason? That reason is any expenses, okay? Any expenses that are considered as long-term value adding should be investments. This is the second fundamental reason to why we make those adjustments. Let's read it again. Any expenses. Now, where are expenses? To arrive at operating profit, you deduct your expenses. No? Operational expenses, marketing, selling and distribution, R&D, transport, whatever. All these expenses are deducted and then you arrive at this. Now, we take a closer look at these expenses. Right? Let's look at these expenses. Are they considered, can they be considered as long-term value adding? Now, when I say long-term, more than a year. That's what long-term means. And do they add value to the business in the long run? Then those are not expenses. You should consider them as investments, which means you reverse those expenses, increasing the operating profit, and bring those expenses as investments to your capital employed. That's the second major adjustment. A third adjustment is for unusual items, which you don't really see here in this case. So these are the three main types of adjustments, two of which are what is relevant to us. Now, if you ask me, altogether there are more than 160 adjustments you can make to the accountant's residual income so that you arrive at EVA. But for us, for P5, we have 4 main adjustments to learn. But this is the thing, I don't want you to remember these adjustments in a very technical sense, right? Okay, there are 4, in fact there are more than 4. Why I say 4 is because then you can remember, right, these are specific situations. But end of the day, all you just need to do is go with cash basis. Any accruals, any concepts, any non-cash figures should be reversed, should be adjusted for. and any expenses that are long term and value adding should be considered as investments and therefore capitalized. Is that clear? These are the two reasons. So on that note, what I've done is I've actually given to you a very valuable note which explains, which takes you through economic value added in the most simplest form, written by a well-known economist, right, Nick Ryan. So go through this. He takes you through the entire story in a very beautiful way, what EVA is, NOPAT is, etc. And there is a sum. An extract from the income statement of Alpha Inc. shows the following, not this, right? You go through this note. I will also take you through this. Here, finally, I pitched the story to you. I've told you what we do. We get these three numbers and we adjust them. And why do we adjust? Or what are these adjustments? One is converting accruals to cash. The other is capitalizing any long-term value-adding expense items. That you can do using example 3. But before that, you can try example 1 and 2. Both the answers are given. Example 3, of course, the answer is not here. Okay. So example 3 is something that I am looking forward to getting the answers from you when we do the live session. Make sure that if you have time, if you find the time, make sure you try it and apply it and get the answers. Okay, and you give the answers, or you share the answers with the class, and we can do this sum in the class. This is what economic value added is. And after we become thorough with EVA, just go through the advantages, disadvantages. We will look at them during the live session, and that's pretty much it for that component of measuring divisional organizational performance. ROI, RI and EVA, economic value added. Here you see, right? So you can go through the slides as well. Finally, we look at this section called value based management, VBM. Trying to answer a few questions on VBM. It's a simple idea, value based management, a very small portion, which is VBM is known as an approach to management whereby the company's strategy, objectives and processes are aligned to help the company focus on key drivers of value drivers. Our focus, entire focus is aligned to the key drivers of shareholder value. Yeah. So VBM takes the interest of its shareholders as the primary focus. It begins with the view that the value of a company is the total value of its discounted cash flows. So value of a company is known as the total value of its discounted cash flows. That is why in business valuation we use NPV. We use the discounted cash flow technique for NPV calculations because of this definition, discounted cash flows. Now, important to note, what about non-cash flows? Non-cash flows are not part of the value because they are not cash flows, you are not making the money. So even in EVA, why we saw that transition from accruals to cash basis is because it's important. Knowing the cash value, knowing the solvency position of your business. Therefore, effort should be made at all levels, strategic, tactical and operational, to increase the value of these discounted cash flows. Some examples for value drivers, as in if you change these drivers, if you affect these drivers, if you increase these drivers, your value, your entire business value will react accordingly. So what are these examples of value drivers? Revenue, operating margin, cash tax rate, incremental capex, working capital investments, cost of capital and growth period. Didn't you see all these when you did NPV calculations? You had your revenue, you had your margins, that is costs, you had your tax and tax depreciation even. You had your initial investments, you had your working capital investments, you discounted the weighted average cost of capital, and you use the terminal period and growth rate and growth period to get the terminal value of the business. So these are some of the examples of value drivers. It's a simple idea. How do we measure value in VBM? So EVA is the primary measure, where positive EVA is behind the idea, or it means that your business is creating incremental value. The value that is created through your business is much more than what it was yesterday. That's EVA. Number 2, market value added is the total EVA up to date. Accumulated EVAs generated since the organization was formed. So you take the sum of all the EVAs from the day the business began. You would call it the market value added. I think young entrepreneurs nowadays, of course, EVA is very popular because it looks at all the particular angles that you can look at performance through, especially divisional performance in this case. And finally, SVA, shareholder value added, which uses discounted cash flows, values the entire business rather than one project. As we talked earlier, shareholder value added, rather these are all the same, calculating value and calculating business value ultimately can lead to entire business valuation. That is what they mean here, shareholder value added. Implementing VBM, strategies developed to maximize value, key value drivers identified, what you need to do. It's like the CSFs for the organizational goals and objectives. So here maximizing value is the idea. To do that, we need to identify our key value drivers. Then we plan and work towards achieving the goal. Performance metrics and rewards for all levels of staff is aligned to targets. That's number 4. Okay. So what's good and what's bad about VBM? It focuses on value, very good, not just profit, and which means you will be conscious about the environment, you will be conscious about all the other factors you are or we are generally not comfortable with. And finally, EVA is one of the main measures used, and therefore the pros and cons of EVA also apply. Disadvantages: we have to adapt the MIS, Management Information System, to adapt to the current measures. Number 2, it can become an exercise in valuing everything and changing nothing. So this whole valuation process can go overboard, and you produce reports and reports. You've dedicated your internal staff to help them. Everything is done, but finally it has become a too detailed exercise where change has not occurred. Which is why the best way to conduct a VBM evaluation for a company is you identify a certain issue and then you start remedying that. So as new issues keep propping up, you haven't waited until so many issues accumulate. What you've done is you've sorted out one issue one by one. That's how this works. That's VBM for you, and that takes us to the next section of the chapter, transfer pricing. Transfer pricing, of course, is something that you will see through my other videos. Make sure that you go through them, and I will usually break down divisional performance, RI, ROI and EVA separately and transfer pricing separately. So this is it for today or for now. With this segment, we particularly looked at ROI, RI and EVA, the 3 key metrics of how divisional performance is measured and managed. Get ready to do some sums in the class, guys. On that note, have fun, take care, stay safe.